Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome to this video on why over-leveraged oil and gas firms aren't investing. In this video, we'll explain how high debt, rising interest costs, and lender pressure are forcing companies to pull back on drilling and maintenance. It is January, and the energy world looks different than many predicted just a few years ago. While oil prices remain steady, a specific group of producers is struggling to keep up. These are the over-leveraged firms, companies that carry a mountain of debt compared to the actual cash they bring in each month. Instead of pouring money into new wells or fixing old equipment, these businesses are tightening their belts to a dangerous degree. The problem is simple. Debt costs have stayed high, and lenders aren't as friendly as they used to be. When a company owes more than it earns, every extra dollar goes to the bank rather than the oil field. This lack of investment creates a ripple effect throughout the entire economy. You will learn why these firms are pulling back, what red flags to watch for, and how this trend impacts everything from your gas prices to safety in the fields. What's stopping heavily indebted oil and gas companies from investing in? Think of a household that took out a massive mortgage, 2 car loans, and maxed out several credit cards. Even if the parents get a small raise at work, that extra money doesn't go toward a home renovation or a newer, safer car. It goes toward paying off the interest. This is exactly what is happening to many oil and gas producers right now. They are stuck in a cycle where their past borrowing dictates their future survival. In the era of cheap money is firmly in the rearview mirror. Interest rates have stayed higher for longer, making it expensive to carry old loans. Because these firms are seen as risky, banks and private lenders are demanding much stricter terms. If a company wants to borrow more, they often have to prove they can pay down existing debt first. This creates a trap where the company cannot afford to grow, but it also cannot afford to sit still. Debt is eating the budget, interest, refinancing, and stricter lenders. Many firms are hitting what experts call a maturity wall. This is a specific date when a large chunk of debt becomes due all at once. If a company can't pay it off, they have to refinance. In today's market, that usually means trading an old loan for a new one at a much higher rate. This jump doubles their interest costs overnight, leaving almost nothing for the actual business of finding oil. Lenders are also putting up more guardrails. They might require a company to sell off its best land just to pay down a loan. They often insist on strict rules, known as covenants, which forbid the company from spending too much on new projects until the debt reaches a certain level. Key terms to watch in financial reports. Net debt. Total debt minus the cash sitting in the bank. Leverage ratio. A look at debt compared to earnings. Covenants. Promises made to lenders to keep debt in check. Maturity wall. The deadline when big loans must be paid back. That's why many over-leveraged oil and gas firms are cutting investment, even when oil prices look stable. In the next video, we'll explore the hidden risks of underinvestment and how to spot warning signs in company reports. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.